In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. That's where we start getting into these pricing relationships. So we wanted to share that with our viewers out there and our traders. And so let's start off with our Chalk Talk for today. Now, again, for anybody who's new, and I know I explain this every single time, but if you're new, we like to put up a little thought question, jot down your answer, think about it for 10 seconds or so, and then we'll come back and revisit it at the end. And then hopefully the presentation will help you answer it as well. So are we ready to go, Stu?
Let's do it.
Here we go. All right. We've got the stock trading at 100.
Yeah.
You own the 105 call.
Okay.
Now, notice I didn't even specify the time to expiration.
Doesn't matter.
Kind of an interesting thing. So the question is, what's the maximum value of your call? What's the most it could ever trade for? Kind of interesting. So this is a pricing relationship. We'll give people a hint. It can't go below zero. That would be the floor. But what's the maximum? All right. So we're going to look at some of these pricing relationships. And so our topic today is what's the maximum option value? So we're going to be looking at calls and puts. And then in the future, we're going to bring these into showing you a really interesting relationship, why calls are puts and why puts are calls. It's not just a catchy saying. They really are the same thing. It's a matter of perspective, whether you're looking on the top side of the risk graph or on the bottom side. And so if you understand these things, that's what will help you to become a better trader, to understand some of these relationships and where you might have an edge or where you might want to get out of Dodge and say, I don't want any part of that. Although, Stu, as I
stated on Q&A today, as Bill is kind of going through these graphs, remember what options are. The owner has a right, and the owner has a right to buy the stock. Think of it as money. It's a stock price. It's representing cash. Mm-hmm. And the seller has an obligation, and the buyer of a put, it's the same thing, except it's the right to sell the stock at the strike price.
The strike price.
So just kind of keep that in your back pocket as Bill is going through some of these explanations.
Yep.
I think it'll really help.
Yep. So let's start off with a call option. All right. So the call is, as you just explained, is the right to buy shares for the strike. It's never an obligation. So if you think about it, the very most you will ever receive is shares of stock. So
it's
there's
your
no
right to buy the shares
of stock. So if that's the very best you're ever going to get, well, there's no reason to pay more than the current stock price.
No,
and that's why.
Real quick. These are not. Some people are already. Probably some people are already thinking about warrants. These are not warrants.
That's right.
These are options. Warrants can carry an available, exercise into shares of stock and something else. Maybe a stub, maybe an additional piece of shares. But these are just call options. They're everyday call options. Unless otherwise specified, they give you the right to buy. These are calls. Buy 100 shares, and that's it.
Yep. One of my favorite examples or ways to show this, and I think we talked about this in Q&A, if I give you the choice, I'm either going to give you 100 shares of stock or I will give you, let's say, the $100 call. Which would you take? There's no cost to you. Which one do you take?
I'm taking the shares.
Right. Why would you take the shares? Because the option gives you the right to buy the shares.
Why wouldn't I? Why wouldn't I take it for no cost? Why wouldn't I take it
for no cost? The option. Now, see, when we start introducing prices, that changes things because now we can use it as an insurance policy or a hedge to see how things unfold in the future.
Which carries a premium, which I may not want to purchase, which you're not really offering that I have to buy. So if I don't have to buy it, why would I buy it?
Yep. So the point that shows is that the stock absolutely must be worth more than the call. Now, when we get into the option pricing, the question is, how much less is that call option? But I think that's a really simple way to show that the call option can never exceed the price of the stock.
I was just going to say the answer to the Chalk Talk was just given. If anybody didn't pick up,
if anybody's paying attention. So anyway, let's take a look at a risk graph. Now, this is actually a little different from a risk graph. Normally, our risk graphs sit below this zero line.
So if we paid $5 for this option, we would see it sit down here at -5. This is actually a little twist on the same idea. This is called a payoff diagram. And there's some reasons that we like to look at payoff diagrams. It just makes things line up easier. So just in case anybody's wondering about that, you could think of it as though you're paying 0 for the call.
Yeah.
But what we're looking at,
what will the option be valued at? What will it pay?
What will it pay you at expiration?
At expiration, yeah.
Right. So
Is that what this is? This is an expiration payoff? Yeah.
Well, the black curve is the expiration graph. So that means the final seconds in of the option's life. So there's the bend. So this is a 100 call. So we see for all stock prices at 100 or below, at expiration, the option pays 0. That does not mean that you lose 0. We haven't accounted for the cost. We're just saying this is the payoff.
Right.
And if the
Otherwise
stock
known as a worthless option, we've all, come to marry a few of them in our lifetime.
Absolutely. And on the flip side, if we come out this way, we're on this 45-degree angle and we earn dollar for dollar, just the intrinsic value. So I know I've gone out quite a ways on this graph, but let's say if we were here at 125, we know if we trace a line straight up to that black line and look left, it would pay off $25.
Mm-hmm.
If we were up here at 200, we look, the option would pay off 100. This is just the intrinsic value. And that'll be important in just a minute. Now, this red line is the current curve, and it's showing us the additional value in the option over and above any intrinsic value. So notice the red line never sits below the black. It's just additional value. Where is it the widest gap? At the money. At the monies have the largest extrinsic value. And as we start going deeper in the money, we start converging on the stock. As we go deeper out of the money, we start converging on worthless. And if we're somewhere near that strike, we have some additional value. All right, so this is what we're going to work with. And the question is, how high could that red line go? And it's sometimes hard to see, which is why I've zoomed out so much here, because normally when you're looking on your broker's platform, you might just be zoomed in this very tight section. And it becomes difficult to imagine where that red line is going. Is it heading up this way horizontally? Is it going to invert? Is it going to curve? What's it going to do? Well, that's why we're going to look at a bird's eye view, and let's see what it's going to do. As always, little pit stop here, Stu. For anybody who's new to markets, trading, options, please check out marketrebellion.com/get started. Lots of great information, videos, tutorials, all kinds of things, absolutely free to help you get started. So let's now take a look at a payoff of the stock.
Here's a question for everybody to kind of think about while you're doing this.
Sure.
Bill. So if you have a $100 stock and a 100 strike price call, what would you pay? Would you pay 50? Would you pay 75? Would you pay 100? Would you pay 125 for that call? What would you pay?
What's the most?
What's the most you'd pay? Would it make sense to pay 150, 200, 300? Just something to think about. Go ahead, Bill.
Yep. So that's what we're looking at here. Now, on the same payoff diagram, we've got a shares of stock on this black line. And it's also at a 45-degree angle because it always pays off dollar for dollar with itself. Everybody knows that who's traded one for one, delta one, always.
Run rate, called the run rate. Yep.
Yeah, rise over run. Now, we also see that it's a straight line, which is another fancy way of saying that we have a simpler way of saying we have no gamma. Gamma is the curvature of the options price. So we can see if we're on the black line at expiration, we have no curvature, no gamma in our call. If we're out of the money, we have no gamma. But if we're right here at the money, we've got a ton of gamma. And the closer we get to that expiration bell, the more curve that red line gets as it starts.
Yeah, so I was just going to say that, 2 years out, you're not going to have a whole lot of curvature, but, today you're going to have a whole lot of curvature for tomorrow's expiration.
And that can be a huge benefit. As we know, our guys in the pit talk about this all the time, about using the zero DTEs for this very reason.
Yeah, this is why Gregory likes to use these from
on Friday.
Sometimes the same day on Friday. I mean, they just explode with delta when you get them right.
For no movement.
Yeah. And when you get them, and when you don't get them right, because there's no really any time left, they're relatively inexpensive options. They just explode with that delta from the high gamma. So
Absolutely.
it's a really cool option. It's a really cool kind of a trade.
Yep. So back to this idea here, the stock, we can see this black line sits above the call option, the intrinsic value, which is what we just said before. The stock absolutely has to be worth more, or at the very most equal to, but for the most part, it's always worth more than the call. Again, that's because the very best you can exercise this call into is 100 shares of stock. Now, here's where things get interesting. These are the risk graphs in red, and I think I did these for a 2-year option, 720 days. I think this red line, it doesn't really matter, but I think I did the red line at 25 vol, and then 50, 100, 200. We just kept cranking up the volatility.
Uh-huh.
And we're trying to see just how high this line can go. So
Think
if
of
we
crazy stocks like GameStop, some of these like, insane
600 volatility, right? Stuff that remember, just because it's not normal doesn't mean it can't happen. GameStop, I think, topped out at about 650.
650, yeah.
But if we do this, look what happens. That red line gets pushed further away. And we can see we have to go even deeper in the money to get it to behave like stock, because you can see we've got a little gap right here, this little white space, whereas we don't have it on the red line.
And interestingly enough, a little side note, everyone. So generally we think about increased volatility when the markets are going down, downside. That's when, the whole VIX thing, VIX inverse relationship to the market direction. These special situations like these meme stocks, and GameStop is just a textbook example. The volatility was actually coming from the upside movement.
From the upside. Yep.
Stock was 50 and then it doubled to 30 and then it doubled to 60 and then it went to 100. So now the world is kind of saying like, holy, you know what, where can it go? Like there's just no top end here. And that's where the volatility was coming from, because it was just the upside was, even though we say the upside is like an infinite number, I mean, in reality, how high can it go? I mean, it feels like it's painful.
And people are willing,
literally like just insanity. A $10 stock that was 200, 300, 400. And this is what was going on.
Yeah. And people are in those cases are more willing to buy the call in case they're wrong. They're after the insurance. So it still has this element of uncertainty and volatility, which is exactly the same as if we're fearful of the downside. So let's push the volatility up some more. What's going to happen to this line? Gets pushed out some more, and notice it's starting to get straighter. That's another way, a good visual to show that our gamma reduces as we go further in time. Notice it doesn't even matter if you're talking about at the money, in the money. I mean, until you get way out here, for the most part, it's getting to be a straight line.
Great illustration about what happens to what happens to pricing and what happens to deltas and gammas as well as you start to increase volatility.
Yep. So let's push it out some more. And now we come up this way. And if we push it out even more, which there actually is behind here, there is another line underneath there, a red one, and you can't see it. Why? Because it's exactly the same as the stock.
Now, and if we keep in mind, everyone, this is extreme.
You will probably never see it. It could, but you will probably never see it in your entire trading career. Right. So we're just showing
just a lesson on extremes. It's always good to like kind of look at extremes to give you a little bit of perspective about what can happen, in front of
just in case.
Yeah.
Right. So for anybody who thinks that the out of the money options can only go to a delta of 50, that's mostly true, but it's not always true. Or that you're in the monies are going to sink. They're going to go from an 80 delta towards 50. It is mostly true. It is not always true. And that can get people hurt. So in this case, we can see that if we had gone another 5, 6, 10 lines out here, you can't get past that wall.
Especially when it will get you hurt, especially if you're trying to use stock as a hedge against a position. Man, that really messes things up. Because if you're hedging, like, say, delta neutral, and you got a certain amount of deltas in your option position at one volatility, and then it dramatically changes to another volatility. All of a sudden, you don't have the right number of shares, and it goes the wrong way. Man, you are just you are buried.
Totally unhedged, right? So that's kind of a good visual to show what is happening in the extreme. And again, be very careful about people who think we've talked about this Trumpification effect, which again is where your out of the money deltas, let's say, might go from 30 to 50. Your in the monies might go from 70 down to everything gets compressed to 50.
Mhm.
That is true under normal conditions, not when you start pumping up volatility to extremes. They will all go delta one.
Yeah.
They will all go delta one. Look at our gamma. 0. And of course, if we pumped it out here to this black line, it's definitely 0. Your shares of stock. Now, an interesting thing, Stu, what if we had even pumped this up, even though the longest dated options, if they have leaps, are about 3 years. The SPX has super leaps, which go out 5 years.
5 years, yeah.
But there's nothing that says we can't tweak that in the model. We could say, what if it has 10 years or 20 years?
Or 20 years, which
Or 2,000% volatility. You
Look,
cannot get past that black line.
a 3-year option, if you do it 3 times, is a 9-year option, isn't it? I mean,
Yes.
I mean, the idea never has to end unless you want it to end.
Correct.
It's just
Yeah.
Never. Another side note: never let your idea be governed by
The expiration
an
date.
expiration date. Right? If you like
we
the idea, just roll it out. Just keep it going.
We see that all the time. So the
I hear it
thing
a lot.
is-
I hear, I was long this option, I was long this call, and it expired on Friday, and on Tuesday the stock was up 15%. Man, these options blow. No, you ended the idea.
You ended the idea.
Suppose you had an option that was an additional week. You had bought a 2-week option, but you really had, make pretend you bought a 3-week option. Would you have ended that idea at 2 weeks? You allowed the expiration to
govern it, right?
To end it, but that's on you. That's not on the options.
That's right. So the thing to see here is that you cannot, and this isn't just a limitation of the market saying that a leaps is generally 3 years, push it out as far as you want. You cannot get that call's price to go past the current stock price, no matter
Why would
where.
anybody want to pay more than?
And that's the simplest way to see it. Why would they?
I don't know. I can't.
So that's where they're heading to. All right. So that's our stock our long calls. Let's go take a look at puts. And before we do, quick reminder for everyone, marketrebellion.com/get started. All kinds of free tools.
If it's free, it's for
No
me.
cost.
I'm in.
Yep. Take it. Good stuff. So let's take a look at put options. So a put option is the right to sell shares for the strike, which is what you said earlier, just kind of the opposite of the call.
Mhm.
And so the very most you will ever receive is the strike price.
That's right.
Same
Exercise your stock
same
and
kind
you
of
get
concept.
cash.
Before, although we were saying the most you could receive is the stock price, this is now capped at the strike. So then we have to say, well, there's no reason to pay more than the strike price for a put. So let's take a look at our payoff diagram. Here's a $100 put. There's our bend. The put option pays 0 for all stock prices at 100 or higher. And it pays off $1 for every dollar below that, right? So if our stock is
Bill,
down here.
how about this? So if we have 100, if you and I are in a pit, and we're trading the what month is this? October. We're trading the tomorrow is the 6th. October 6th, 100 strike put.
Mhm.
And you bid me 105 for it.
Mhm.
That's not $1.05. That's 105. What am I going to say?
Gone.
Sold. It's all yours. Take it.
Yeah,
Right.
take it. So again, what we're seeing here is the intrinsic value. All right. So we know that the put option has to be somewhere above this level. Cannot live out here. This would be an arbitrage out here. So now let's add some volatility. We get our typical curvature. And the question is, where can this go? Is it going to flatten out? Is it going to invert? Is it going to bow out? What does it look like? Well, let's add some more volatility. We'll add some more and some more. And eventually what happens?
100.
We flatten right out there at the strike. That is the very best it's ever going to do. So the put prices have to live somewhere between in these black boundaries.
Because
They
look,
could-
at the end of the
live up
day,
here or
the
down
stock
here.
can be 0. And if you have the right to sell it at 100,
The very best you're getting is 100.
it can never be more than 100. Not
Right.
that it ever really will be, but
Although, Stu, I think we saw that on GameStop when it was around.
I took a look at it. It wasn't quite there, but it was getting there.
What was it? Well, it was $40, right?
It was about 40.
And what were the puts?
The puts were puts were when the stock was about 200, the puts were, I believe the puts were maybe $20. I'll have to go back and take another look at it.
Okay. There was one time I thought we saw where the puts were priced pretty close to the strike price.
It might have been one of those
It
days.
just gets crazy because remember, any volatility in the calls through put call parity has to get transferred over into the puts. And that's why these put prices can absolutely explode, even though there's a ceiling on there. And you need to know that as a trader, you need to say, why would I want to pay $90 for a 100 strike put? You can't just say, oh, it's an insurance policy. Oh, it can go up in value. There are limits. So now let's put this to the test, Stu. Let's go to our favorite little pricing model here at the OIC. And I put the stock price at 100. I'm going to pick an out of the money call, the 105. We're going to put 1,000 days to expiration, 2,000 vol. And again, it doesn't matter. You could pick and just large numbers, crank them up here. 0 interest and no dividends. And notice that our call option is hitting the price of the stock and the put option is hitting the strike. We also see the call is delta 1, gamma 0. The put is delta 0, gamma 0. And so we're saying that this is the absolute limit. You can crank this up to, you could make days to expiration 2,000. These numbers won't change. 5,000, 10, make it 1,000,000. It's not going to change. And so you need to understand these are the extreme boundaries, and there are others that we look at in Q&A, and that we're going to start doing next week, some interesting pricing relationships. But you have to understand these to really do well with strategies. Now let's flip it. Let's do an in the money call. So let's go with a stock at 100. Let's make it the 95 strike. Keep everything else the same. What happens? The call price stayed at 100, right? Look at the previous slide. It was 100 because that was the stock price. We change it to a 95 strike. It still goes to 100. What happened to the put? It went to the strike. And so those are things that you absolutely have to understand are these boundaries where option prices are allowed to live and trade if you're trying to get your trading to a higher level, because obviously the better way to trade is to say if there's an edge in your favor, or at least a perceived edge. And that means you have to have some idea of where these prices can live. Are they getting
kind of the only way to trade, Bill?
It is. It is. The worst thing to do is to say, I'm going to buy a call because I think, or I think the stock is going higher. That is absolutely the wrong way to go about it. And unfortunately, Stu, that's the way that we hear most people attack the markets. So let's take a look at our chalk talk. The stock is 100. You own the 105 call. What is the maximum value of your call?
Yeah, I think we answered it like 10 times already.
I think we did. So that would be 100.
Can't be more than 100, right?
Now, again,
and the bottom line is, everyone, look, it's $100 stock. It delivers the stock.
Right.
And if it's delivering the stock and it's $100, then why would you pay more than that?
Correct.
It just doesn't make any financial sense.
And if somebody did, if this were trading at 101, sets up an arbitrage where there's free money. So that's another way to show that it absolutely is not going to ever cross that line. That would be death for the buyer for sure. So anyway, we hope that helped you to understand two of the really the extremes, but some of the most important pricing principles. And I think from time to time, Stu, let's throw some of these in.
Yeah.
Look at minimums, some maximums,
absolutely,
some ranges between strikes, different interesting relationships. And then one time we will show people why a call is a put and a put is a call. One of my favorite graphs to show.
The whole synthetic theory. Love it. Yeah,
absolutely. So we hope that gave you something to think about. We appreciate you being here, and we will look for you next Thursday, 4 p.m. Eastern on Coach's Corner. We'll see you then.
See you.